Welcome YouTube family and welcome to the Kevin Strong Show. And in this video, we're going to talk about investments. Let's say you're a little bit scary out there and you don't really like real estate. You don't really like the stock market because you're too concerned about losing your money, but you want to do something conservative. You just don't want to let your money stay in the bank because it's not really earning that much interest. So I have two solutions for you. T-bills and CDs, certificates of deposits. And that's what this video is going to be about today. As a full disclaimer, I am not a financial planner or CFP. This is not tax advice. If you are contemplating making an investment of any type, please consult with a certified financial planner or accountant. So before I get into this video, I got to share something funny with you because you know it's part of my personality. So I'm in the state of Washington for some of you guys who are in different states, about 35 miles south of Seattle. And I go to this grocery store in Sumner, Washington called Winco. It's kind of like a discount place where you can get pretty good stuff there, right? So I'm in the aisle walking. There's a really, and I do mean a really attractive woman. And she kind of makes eye contact with me for a minute. Keep in mind, just bear with me because everybody knows I got a sense of humor. And she pauses for a second and she says, "You have a really nice smile," right? And, so I kind of smile a little bit. She had a ring on or whatever. So I think it wasn't anything like that. I think she was just complimenting me. So I don't know what made me possess me to say this. So I kind of pulled back a little bit. I said, I'm kind of offended by that. And keep in mind, we're near like the candy section because that's where protein bars are and candy and all that kind of stuff. And she's like, "I'm sorry, I didn't mean to offend you." I was like, "Well, I was hoping that you were going to compliment me on my skin complexion." So she starts laughing her ass off, right? Everybody that overheard this conversation starts laughing. So you know me, the nut that I am, I'd start grabbing freaking candy bars. I was like, "Come on, guys. Who doesn't like chocolate?" Huh? So everybody in the goddamn aisle just started laughing. And she's beside herself just laughing. So that was it. I said, "Man, I got to get on stage." So I'm hoping to get this thing done, this open mic thing at the Tacoma Comedy Club. Probably, I think I'm going to do it on my birthday in April. I know I said in the first quarter of 2024, but I think it's going to be in April. But true story, nothing happened for all you guys. You got a dirty mind. It was just a compliment. She was married. I wasn't going there, but it was just an opportunity for me to express my sense of humor. So if you're laughing right now, even before the video's over, take a pause for the cause and smash that like button. If you haven't subscribed, subscribe because I probably will make you laugh at least once during most of my videos. So without further ado, we're going to jump into this and talk about the difference between treasury bills and certificate of deposits. I will attach this article to the description for those who want to follow it. Once again, this article came out not too long ago, February 16th. So it's a recent article and it deals with CDs versus treasury bills, maximizing your savings. Once again, certificates of deposits. Some of you heard the acronym called CD. So we're going to talk about treasury bills first. So basically, from 2011 to 2021, there was only about 2.4 million accounts that were created on the Treasury Direct website. We're going to go to that website before the end of this video so I can show you how to set that up and what the procedures are. So, but in 2022, right, it went from 2.4 to 3.7 million people opened up new accounts. So why did the number of accounts increase almost by a little bit over 50%? In my estimation, this is when the Federal Reserve, Jerome Powell, started raising interest rates. And as a result of that, the rate of return that you can get on T-bills started to go up in concert with the Fed raising rates. And then people started to wake up finally and say, "Holy cow, I can get way more money by investing in T-bills or certificates of deposits opposed to just letting my money sit into a standard checking and savings account when I'm getting absolutely nothing." So that is the big push. When the Fed started to increase interest rates, that's when the average Joe Smo woke up and says, "I'm going to start doing something with my money and get a better return than just leaving it in my account." You can purchase T-bills with the maturity date of 4, 8, 13, 7, 26, 52 weeks, even longer. You can go years down the road. I personally like to do 4-week T-bills because they give you a good rate of return. They are liquid. You can access that. And then you don't lock your money up for a long period of time, because if you do a longer T-bill and then inflation starts to go up considerably, that's going to eat away because you've already locked in at a certain interest rate. So as inflation is continuing to go up, you can't take advantage of that. So I like to recycle that every 4 weeks so I can adjust it accordingly. Hopefully that makes sense. So T-bills are sold at a discount from the face value of the bill. When the bill matures, you are paid the full face value. So I'm going to explain that in layman terms. Let's say you decide to buy a T-bill. You purchase a T-bill, a treasury bill for $1,000. The government says, hey, give that money to me, and in a year from now, I'm going to pay you 5%. So at the time you buy that T-bill, you get a 5% lock-in on the T-bill. When the government takes the money out of your account, they're already going to deduct the amount of interest that you're going to make on that particular investment. For example, a $1,000 investment in a treasury bill over 12 months that's giving you a 5% return. At the time they take the money out of your account, it's going to be $950 in this example. 12 months later, they're going to put $1,000 back into your account. And the difference between what they took out and what they put back into your account when the T-bill matures is the interest that you've gained. In this example, you bought a $1,000 T-bill for 5%, but they only took $950 out. And then when they put the money back in, it was $1,000, and that $50 represents the 5%. So that's probably the most simplistic way of understanding it, because a lot of times when you start doing this, you're going to purchase it at a certain amount, but the discount's going to be lower than what you purchased it for, because the difference is what they're paying you in interest. So let's talk roughly about CDs. According to the Federal Reserve, just about 6.5% of Americans, adults, hold CDs as of 2022. Nothing's wrong with them. They're not quite as liquid as a treasury bill. You typically get your CDs from a bank or something like that. You can also have your bank purchase T-bills for you. Some of them will do it for a fee. I personally like to go directly to the source, which is treasurydirect.gov. And we'll talk about that. But here's one of the differences when you're talking about investing in a CD compared to a treasury bill. When you open up a CD, you deposit money into an account and you agree to leave it in there without any withdrawals or additional deposits for a specific period of time. So going back into my example, in this case, you give them $1,000 for the CD and you're going to lock it up for 12 months. You're basically telling the bank, hey, I'm not going to access this money for 12 months. And in the event that you do, there could be, or chances are there is, an early withdrawal penalty for doing that. And any interest that you've incurred during that period, you can lose some of that as well. Once again, most of these pay a fixed rate of interest over the terms. We've just talked about that. Typically, you'll have to forfeit some of your interest you've earned if you take it out prior to its maturity date. A CD is a safe investment. The investment is backed by the FDIC up to $250,000 in the event that the bank fails. Now, the T-bill is backed by the full credit and faith of the United States government. So if we have a financial Armageddon, where do you want your money? You want it in a T-bill. We already know that the federal government's broke, but sure as hell is the FDIC is also broke. The FDIC is an entity within the federal government. Follow me? So if the federal government is broke, by default, the FDIC is broke. So just deal with T-bills, in my humble opinion, not financial advice, if you're worrying about the optimum place to place your money and to reduce the chances of you not getting paid or getting access to your principal. So let's talk a little bit about the tax difference between the two. But before I do that, once you get interest on a T-bill or a CD, basically this is the form that you get either from your bank or from the Department of Treasury. It's called Form 1099. It's an interest income form, and that's basically going to state the amount of interest that you have accumulated in 2024 investing in T-bills, CDs, or a combination of both therein. because that income is taxable income. Okay, so you have to declare that on your federal tax returns. So you have to use that Form 1099. Now, the tax difference between the two, once again, this is not financial advice. I have to keep saying that. On average, one of the discernible difference between a T-bill and a CD is that a CD, a certificate of deposit, is subject to local and state taxes. A Treasury bill is only subjected to federal taxes. It is not subjected to local and state taxes. So if you're in a state that has a state income tax and all else is pretty much equal, you're looking at a 12-month T-bill. Let's say the T-bill is paying 5.3% and the CD is offering a little bit higher rate to attract people because they don't understand this. Hopefully they do now that they're watching this video. It's at like 5.6%. You have to factor in the local and state taxes, if applicable, because the net result might mean that that CD is actually returning less money because of the tax implication, opposed to you just going with the lower T-bill interest rate, but that bill not being subjected to local or state taxes. So hopefully that works out. Let me go ahead and quickly go over to this website because I know this video is getting kind of long, but I think it's important because a lot of people want options of where to put their money in a safe environment. So we are here now. This is at the website treasurydirect.gov. I will also put this in the description along with the other article that talks about the difference between CDs and Treasury bills. So you would come here, you set up an account. It's very, very safe. Treasurydirect.gov has never been hacked. It has a lot of safety measures involved, and I'll get into that shortly. So you would go here once your account is set up and log in. And when you click log in, you'll get here and it'll say, if your account number starts with a letter, click the next button. Chances are you're going to say yes. I'm not going to do it because this is actually on my computer. You go down here and you put in your account number. Then you click submit. The next page that shows up is it will ask you for a password that you created. Once you enter that password correctly and click submit, it's going to generate another safety protocol measure. It's then going to acknowledge, okay, this person has the right account number, this person has the right password, but before they give you access to purchase a Treasury bill or manage your existing account, they're going to generate a one-time password to your email of record that you use to establish this account. You're going to take that password and come back to this website and plug it in the appropriate box. Click submit, and then you will have access to either manage your account or to purchase T-bills. So the only way that someone could really compromise this account, if you're doing it directly from treasurydirect.gov, is that they would have to have a couple of things. One, your account number. Two, your password that you created. And then three, they would have to have access to your email, because even if they had the first two parts of the equation, the system's going to generate a one-time password. And if they don't have access to that through your email system, they can't access your account. Each and every time you sign on to treasurydirect.gov, it will require you to submit that one-time unique password. And it generates a new one every time. So the system is always moving. It's very, very, very difficult to compromise treasurydirect.gov. So kind of a different video today. I did get some humor in there, but that is a true story. So I'm just going to go ahead and take the plunge, like I said, and probably ideally do this comedy thing on my birthday. But I'll give you guys advance notice for those of you who are local so you can come check your boy out, because I'm going to light it up. I'm going to light it up. So I hope you enjoyed this unique version of the Kevin Strong Show. This was some practical information that helps you make a decision on how to invest your money in a safe environment so you can fight against inflation. If you have not subscribed to my channel, I humbly ask for your hand on the subscribe button. Smash that like button, comment and share, because I care. This was the Kevin Strong Show, and I'll see you guys in the next video.